All right, guys, Footprint. Now, there was a reason this got left to the end of order flow week. The main reason being that Footprint can often be used as a substitute for order flow, as a way of sort of seeing what's happened and using that instead of order flow. The difficulty with Footprint, of course, is that it doesn't show you the whole picture of order flow because it doesn't show you the passive orders, the orders that are not doing anything. And so that picture that you gain from understanding where people are, even if they're not acting, doesn't actually come through on Footprint. However, Footprint is very useful. So this session is going to be to do with kind of formalizing some of the concepts that we've already talked about. We've covered some of these during the week anyway when we've looked at certain types of action. So it's to kind of try and formalize the ideas, pick out little strategies, ways that Footprint can be used and incorporated into your trading. For me, always look at Footprint from a point of view of trying to define more accurately a point where you might want to be in, particularly when it relates to a retest of an area, and also to try and understand how the order flow is changing. I think Footprint can be very useful for that, just in a kind of general sense of the way that you're seeing what's going on. So let's go and cover a few concepts. Some of you may not know too much about Footprint, so I'll cover some of the basics to start with. The whole idea behind a Footprint is that it will show you every transaction at every price. Now, I'll give you another example of this in a moment, and I'll go through precisely everything that it's showing you. So the big advantage, and this is very, very helpful, is that it prevents you from needing to remember what happened. Now, nobody, no matter how great a memory you've got, can remember exactly the way a market traded, exactly what happened, exactly the price that perhaps somebody absorbed that or the market accelerated from. Footprint gives you that ability. It gives you that ability to look back over a structure and say, okay, this is how exactly it got created. So in that respect, Footprint is exceptionally useful. The other thing, and this is one of the other main reasons to leave Footprint to the end of the week, once you've learned how a price ladder works and you've seen it working, to enhance your understanding of that, Footprint is brilliant, because what Footprint can do is it can allow you to look at a price ladder. You think you've seen something, you think you've seen some absorption or some iceberg, something like that. You can then look at the Footprint, which will confirm what you've seen. And for a lot of people, that's really valuable because it gives you the ability to have confidence that what you are seeing is indeed what you think it is. There's no real other way to do that. And a price ladder won't necessarily give you that information or confirm that information for you. So that, again, is another way that Footprint can be used. And I would use it more as a tool to become better in your understanding of price ladder than I would to use it as a substitute, because I do not think it is a sufficient substitute. You're just not seeing enough information. What it also will give you is the ability to look at an individual candle. Now, we've looked at profile and covered the whole idea of understanding where a move is relative to value. But with Footprint, you can assess that on a candle by candle basis. So you can be very, very detailed on where exactly did things change within that candle, what precisely did happen. That's, again, where Footprint gives you that granularity that you perhaps don't get from a chart, a profile, even from price ladder, which you're watching more for the generalized flow of the action as opposed to the granularity of every single price. So some of the things that we're going to go and cover. We'll look at imbalances, points where buyers or sellers completely take control, and how these will show up and how you can use these later on when the market comes back. This is one of the best ways I find for defining an entry point on a retest of a reversal. So many of them do not go to where you expect, leaving you without an entry. With Footprint, you get that definitive kind of point where you can look for an entry. So we'll look at imbalances. The obvious way of using Footprint is to spot absorption. So this is to see passive activity. What this is to say is that you may well have people buying and sellers go and hit them and hit them and hit them. If you're seeing a lot of that, so basically you're seeing the footprints sort of show a lot of activity on one side, that effectively tells you that there are people willing to get hit, willing to buy, but not willing to drive the market in their own direction. You'll see then how that can change over time. So we'll cover different types of absorption and how absorption can change over time. We'll look briefly at crowding. Crowding is a concept quite similar to profile concept of acceptance. That as a market becomes more crowded, as it builds up positions, then it has the scope to move. So it's about sort of, rather than looking at profile from the perspective of trying to be refined in execution points, the crowding gives you a sense as to whether there is actually much going on at this point in time, and therefore, similar to a profile concept, has the ability to actually get moving. We'll look as well at directional switch. This is the idea of where a market trades in one direction, holds, it builds for a next leg, and then you get the switch. So basically, you get the turnover back through an area where you would expect to see previous action. So we'll come on to all of these, and some of these things you will probably have seen already, even if you haven't formalized exactly how you would describe them or how exactly you would look at them. So let's get on to what exactly is shown on a footprint. What I've put here then is the candlestick next to the footprint of that candle. So this is obviously a time-based candle or a time-based footprint. Personally, on footprints, I would lean towards rotation rather than time. The reason for that is if a market doesn't move a great deal, you end up with a footprint that just shows a lot of volume in one area. Now, that's not really telling you a great deal of story and is more kind of essentially building up a very short-term volume profile. With a rotation-based chart, what you get to see is the movement before a change or before a directional shift. That's much more helpful because then that alleviates the time part of it. So you then get a much more realistic view of the way the market has flowed. When you're looking at a price ladder, you're not looking at it and then thinking, oh, it's the end of the minute, better look away and look back and reassess where we are. You're looking at it from the point of view of how the market moves in certain directions. Now, the question of rotation versus time and what rotations to use is going to depend, one, on what market you use, and two, also on the volatility that is present. So if you take something like S&P, as volatility starts to wane slightly, and so I'm talking the volatility period that you've got at the end of the end of the first quarter in 2023. Volatility starts to drop. You're looking at a rotation on the S&P of probably around about 12. That's 12 quarter ticks. Just to be clear on that, so 3 full ticks. But when volatility picks up, then I think you can be looking much more towards 20, maybe even as high as 24. So that's the kind of level, and you have to vary this with time. You'll see it naturally as you watch a price ladder, how the market is rotating, and can therefore make a decision as to how you want to enter. Right, so what exactly is shown by a footprint? What we've got here, ignore the candle for a moment. At any one point here, you will be shown a number on the right, a number on the left. Now, what this does for you is this effectively shows you the number of contracts bought into the offer. So this is an aggressive buy action. You don't know how many was on the offer there, but you do know that 247 was bought into the offer. Likewise, when you got a bid at 27, 107 was sold into that bid. Again, you're seeing the aggression with which people act. Now, what this doesn't tell you is exactly how this played out. For example, was this a situation where there was 247 on the offer, they got bought, bid moves up, and you have a bid of 800, of which 107 gets sold, and then the market starts to trade higher? Or is it just a bid of 120? So you don't see that passive side of the story. But nevertheless, what you do see is the number of orders at each price. Notably here, you have 38 bought into the offer and absolutely nothing traded into the bid. This is a good sign of strength. So whilst there's not much volume there, what that is showing you is that when a bit of buying comes in, sellers don't even attempt to sell. Further up the candle then, you get attracted, you see where all the action has really taken place, roughly between 28 and a quarter and 29 and a quarter. That's where all the action has taken place. You've got quite a lot more of the dark red up here, a couple of 500s up here. Now what this is showing you is that you're seeing buyers effectively pushing their bids up and getting hit. So what it effectively shows is this is where the battle took place, 29 and a quarter to 28 and 3/4. However, by the end of the candle, we've actually closed all the way back down here at 27 and a half. So that now gives you the sense that what's actually happened is the market has traded up, attempted to trade higher, or attempted to sort of accept trade up here, and then managed to close lower, however, without trading a great deal of volume down at these prices. So it's quite hard to see a footprint or see the entire story of a footprint without seeing this alongside the candle being created or alongside your price ladder. Nevertheless, this has given us a few key reference areas, notably 27 and 3/4 being the area where buyers had complete control. Notably also this 28 and a quarter to 29 and a quarter area where the greatest amount of acceptance happened. So now as you move on to the next candle, you can then start to make judgments from there as to whether the market is able to trade back up or whether indeed this rejection here then turns into a move lower, i.e. tried to trade up there, fall back below, and the market then drops from that point. So that gives you a little sense of what exactly a footprint shows you, how a candle is constructed. Right, so let's get on to a few more simple concepts. First up, passive buying. Now, what we're looking at here is that down as you move lower, and this happens throughout this move. So if you look up here, 392 versus 0, you get 557 versus 206. So what you're seeing there is sellers have to do a lot of work to get the market to go down. At the same time, if you look diagonally across your footprint, so at the point where you had a bid here and an offer here, you actually still see buyers hitting as well. So what you've got is a situation where buyers are willing to be hit, they're quite happy to hit, but they're also quite happy to have a little go at trying to buy more aggressively as well. This absorption then continues down towards lows, and look at the difference between what you're seeing trading into the bid versus what you see trading into the offer. Down at the lows, 20s versus 1200s and 800 nearly. That's a sign of absorption. So what will happen is you get a situation where there is selling. People sell and they sell, but it doesn't generate movement, simply because buyers are essentially just holding them back. They're not letting the market drop. Now, this doesn't necessarily give you a trade. Where it gives you a trade is once you start to get this movement here. Now you have a situation where you can look at that, lots of blue. What the blue is showing you is you have more buyers than sellers at each price. With that in mind, you're now seeing that basically sellers are not continuing to come in and sell. As such, this indicates that the move has turned. You then get the buyers still persisting. So once the market has bounced back up to an area where they were previously, they've now come back again. They're happy to sit up at these prices. So effectively, from a larger perspective, they've bid around this area, around the sort of 03, 04 area. They've been willing to continue to bid down at 95, 96 area. And then once the market moves away, they move their bids back up. So this is showing that there's a willingness to buy across this entire area, but also an acceptance that they may not be getting filled down here anymore, and as such are willing then to actually move their bids higher in order to get filled. So that's what a passive buying move looks like. They're happy to accept being hit on the bid, and then when the market moves higher again, because there are no more sellers, those passive buyers are still willing to sit and get hit on a bid just at slightly higher prices. Now this contrasts them with a more aggressive buying move. So what you've got to think about here is not just simply looking at stuff from the perspective of absorption, but it's the direction with which things move. Because yes, you can say that sellers are absorbing here and here and here, but it's not so much about the individual action at one price, it's about the direction with which that's going. So what this is basically showing you now is that as the market drops, buyers are quite happy to hit off the low. So sellers are effectively pushing this down in a passive way. They're quite happy to sit as the market drops and just sit on the offer, i.e. hope to get filled as the market bounces back. And they do. They get hit. Here you get 1700 by 700. You get 2200 by 1300, double the size, more than double the size again here. Whereas what you don't get is that when you do get some people selling, is they don't then sell and drive the price on. You get a balancing of the number of contracts sold and bought down at these prices. And then where the aggression really shows is here. 1 by 286. So when you get that, that's now telling you the buyers have given up on sitting there and just hitting those sellers that keep on coming down. They've gone straight through them. And having done that, they're then willing to come in again and buy up once more, higher prices. They're still willing to hit anything that comes and sits on the offer down there again and higher up again. And that's then results into this much quicker move towards the upside. So whilst the passive buying is a move where people will quite comfortably just sit there and let themselves get hit and hit and hit, the more aggressive buying, buyers take control. They drive the market higher. They take out the offers. Then you see here, 964 versus 101, and then above that, 32. 32 is all that trades into the bid. What that's showing you is that buyers are coming in, they're not getting the chance, or they're not giving the sellers the chance to sell to them. It's just straight away, buy, 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 and that pushes the price higher. So you get a very different story. It's not just simply about looking at who's absorbing where, but also the direction with which that move takes. That's what tells you a lot about the aggression with which a move is playing out. Right. So you've got the basic concept. What we're going to go and have a look at then is trying to apply some of these things more from the perspective of seeing it before it gets there. Because it's very easy afterwards to say, oh yeah, look, there's some buying, there's some buying, there's some buying. You need to be looking at this from the point of view of thinking, I expect to see that. And when I do see that, that shows me a change. That shows me a little pattern shift. That's what you're interested in. So let's go and have a look at trying to define a reversal point. Now, this is a trade in oil. Quick drop down, market balances, or sort of stalls, I should say, has another go towards the downside and then reverses. So we're looking at how do you define this point? How do you define that turn point where you can say, yes, now we're on our way back towards the upside? Just for clarity, this is an hourly chart. This is the point that we are interested in, getting down to that area to then play for that move all the way back up the range. So let's go have a look. First up, you need to look at the move down. Now, the other thing that I don't think is super important is to know every single number of contracts that's traded at every price. Hence why I've sort of squeezed this up. We're not looking at the detail of numbers at every single price. What you are looking at is the very distinct buying. You get these blocks of buying all the way down this move versus much lighter selling. And again down here. What that's showing you is that there is a significant amount of buying. Buyers are quite happy to sit and get hit and get hit and get hit. But they're continuing to get broken. Every time the market pushes through them, it continues on another leg down, another leg down, another leg down. So this is the move from 75.66. So it's roughly this move here that we're just looking at. Sellers completely take control. They keep on pushing and pushing and pushing on this move. So what changes? Well, we start to see a little bit of change in the seller's behavior. That's the first thing. This is the bottom of that previous little run towards the downside. But now what you start to see is sellers becoming more passive. And you're actually starting to see the darker red beginning to appear. Sellers are now the ones that are essentially stopping the move on a bounce. Think about why this has happened. The main reason this has happened is sellers have rushed to sell. That's what creates the initial move. Once that has happened though, the market's dropped 50 or so ticks, they don't have the same appetite to rush to sell. Therefore, they become more passive. Market starts to bounce back and hits them and hits them and hits them. And that's what you're starting to see here. So that's the first thing. That now shows you that sellers are perhaps losing the aggression with which they're moving. Doesn't mean a reversal is necessarily on, but it does suggest to you that perhaps it is not quite as strong a move down now as it initially was. The initial move is strong, but after that, it needs more time. So we're now starting to see that sellers are quite happy to absorb and trade this passively rather than quite so aggressive as they did on the way down. So the real area of interest then is once you go and break the low, what happens now? Well, once you break the low, this is the kind of the next leg, the bit of the move that all of these sellers are looking for. When that happens, we drop. That all looks good, nice and light. I think, again, just you don't need to be in depth on the numbers, but where you see this lightness, what that's showing you is a lack of willingness to trade at these prices. It shows the market speeding up. That's good. Well, particularly if you're looking for a short on a break. So you've got that, but straight away we run into absorption. Again, this one is around about 105 for 6 contracts. Here you've got 85 versus 21. Here a little bit more even, but still 86 versus 51. Buyers are then back. They're still sitting there passively. They're still happy to take any selling coming their way. So this now says to you, right, we've seen that sellers have slowed down in their aggression. That's what happens here. Now you get the break. Buyers are still quite happy to passively buy this. So the question then is, as we reverse back to the previous lows, do those passive sellers get in the way again? Do they take the initiative to then start to try and hold it down at lower prices? If they don't, this is where the market can turn from. So in terms of defining a reversal point, the area that I'm always looking for is What's happened when we were down at the previous low? That's obvious. But also, what's the structure of the profile looking like? Are we now seeing sellers coming in the same way? Because if you don't, you can now be confident of a reversal. So the first time we come up, market tests the area and rejects. I don't think that's a surprise. You get the first attempt up towards the level and everyone goes and sells it. But what you would expect the next time when you get up there is you would expect to see some absorption from sellers, i.e. they will keep on reloading the offer. You're not seeing that. You get one attempt here. As soon as that breaks though, you don't get any more. So now you have a situation where the market trades again, bit of light volume. That's a good sign that we can now start to move up because we're rejecting lower prices. And even when you do get, and this is minor, that's 38 by 47. So very minor amount of trade. Even when anybody does stand in the way, straight through it and the market continues to move up, even with buying absorption at higher and higher prices. That's how you spot the reversal. It's about looking at the way that we've moved down and then that turning point. When you get back to this area, what should happen? Well, if sellers are strong, it should be absorbed from there. They should come in and stop the market going up. They don't do it. So when they don't do it, this opens the door for the move high. You can be ready for that. You know what to be looking for because you've seen the way that they've done it up here. So if they don't come in, they basically open the door and say, yep, we can continue towards the upside now. So that's a little pattern change. More than just simply being able to look afterwards and go, oh yeah, well, we got absorption from buyers all the way down and then the market turns back up. That's easy to say, but it's a lot more different to sort of being able to say, okay, we've got absorption from buyers on the way down. Are they still there? And then are you getting the sellers actually being able to counter that buying on any kind of bounce? So I thought I'd try and bring this together then with an example looking at a sort of sequence of movement over the course of a couple of hours. This is one the bund rather than the previous one looking at oil. What we're looking at here then is two different types of reversal. First up, we've got a rejection. Now what you have with a rejection is a running out of action. So you don't see this depth of color. And for me, the color is often the more important thing. Just seeing that depth of color makes it easy to visualize. There's not much going on up here. What you're also seeing, and I'll introduce the concept of imbalances here. The little orange numbers that you see, rather than the standard black, is a point where you have an imbalance. Now, when you're looking at an imbalance, you're looking diagonally across the profile. So up here, what you've got as an imbalance is 313 versus 128 above. 313 is more than double 128, hence why it is showing up as an imbalance. So with that being the case, what this is showing you is that as the market has moved higher, where you would expect buying to come in, you've actually got more sellers aggressively acting, selling into the bid at 82, at 81. So when you get that, that's your rejection sign. That's showing you that people have tried to buy and they've just been hit. People haven't waited. They've not waited to get filled trying to sell. They have gone and hit them. In that case, that shows a clear rejection and that can then set off the move towards the downside. On the way down, the selling persists and you have many, many more imbalances. Lots and lots of orange numbers all the way down. Selling continues to hit and hit and hit into anyone trying to buy. And over time, they break through them. Now, this follows a reasonably steady pattern. We drop down, you get some big volume traded over a couple of prices, 2,500, 1,800s, 1,500s traded at a couple of prices there. We then see an accumulation of that type of action here. On the break, we then get more, 2,500, 3,000s, and again, but each time the market continues to step lower. This is then giving you the sense that sellers really are putting the work in and they're pushing the market down. However, they can't do this forever. So when that happens, when they stop being able to do this forever, you now get a change in situation. And it's about the pattern. It's not about trying to say specifically here or there, but really what you're looking at is the pattern of action. Every time those deep blocks of color are coming, where the big selling has come in, it's matched then, once it gets the price down, any buying that comes back, the sellers then become passive as well. So they're acting on both sides. They're happy to sell and sell and sell into any bids, but also as soon as anyone comes back to buy, they will sit on the offer and pin the market down as well. But this then changes. Once you get away from this block, remember, on the way down, every time you've got these big, high volume little blocks of trade, the market continues to the downside. There's your change. As soon as you move away from this to the upside and you move back through the previous high volume block, notably with very little trade there, that's a kind of profile concept. Volume's done, volume doesn't get done on the other side. The market then trades up. And on the back of that, now you see that yes, you have sell imbalances. Sellers have been more willing to hit into the bids, but they're not getting the action this time. So those sell imbalances are showing you that yes, people are trying yet, but they're not getting what they want. This then opens the door for this much more steady reversal until you start to see more acceptance at higher prices. Notably, this rotation, relatively light in color, quite floaty, if you will, on the way up. Basically, this is where people have given up on the idea of this being a sell now and are happy to kind of step out of the way and the market rotates back up. Any sellers are going to be more interested at much higher prices than they are going to be down at these prices. Well, I say down at these prices, mid-range type prices. So there you go, that's a reversal in a couple of different ways. Note as well, when we get back up to the highs, this is where there was rejection. Not a great deal of willingness to trade at these prices. The market comes up and trades almost straight through. So in doing that, you've set up the breakout. But with that breakout not coming, as soon as the market falls back into this zone, that rejection comes again. Not willing to trade up here. So without a willingness to trade in that zone, the market then falls back once more. This is again to do with the direction of the action. Trades up. It fails to keep on going. So now the rejection here sets you up for a continuation towards the downside. So it creates these turning points for you. If this rejection area had held and it then starts to trade up, you'd be looking at that very much as this is the break and now we can look towards stepping further towards the upside. I just talked about imbalances. And what I want to look at or point out here is the concept of using an imbalance as an entry point. Using an imbalance to pinpoint where you might want to be active on a trade. Now, this is a move higher in the S&P. And it's not a major level that gets broken. This is just the continuation of a steady move towards the upside. You don't even have a great deal of technical pattern to use to enter at this point either. But what you do get from a footprint, and this is where it's helpful, is you get this very clear imbalance, in particular, 25 to 199. So buyers completely come in and hit all of those offers. And then you get this very light area of trade. That's showing you that buyers have taken control. There's your imbalance. Now, that, over these prices around 41.20, up towards 41.21.5, doesn't really give you too much in terms of if you're looking to buy, it's not the easiest place to just say, yeah, that's an obvious buy there. But the story of the candle has been told to you. So you can now look at this after the move up, which attempts to stall, and then again, continues very, very aggressively. And this second continuation, the second drive of aggression, is what really holds the market up. Whoops. Above 24.5. It's only on the data that we actually get that faster move down. But where you see at these higher prices, again, the imbalance, this time showing up with purple because it's a buy side imbalance. That buying imbalance, very, very obvious. 4 versus 120, 31 versus 180. Very, very obvious buy imbalance. In this instance, 0 versus 162. Very clear strength. As such, the market uses this as the support area. Why? Because this is the area that buyers have the control. You see this in reality when you see it on a ladder. You see it with that little pocket of low volume, a passive LVN trade. But here, if you didn't see that move, you wouldn't be very clear on exactly where those imbalances came from, where the precision of this can be found. Now, when it comes to the footprint situation, not the footprint, the data, if you're assuming that this is a relatively strong up day, then you can use the data to enter. Any flick down on the data is an opportunity to buy. That's what you're after. So when the market drops back down to this previous imbalance, you've now got an opportunity to buy. Notably, I think the most important thing that you get here, this isn't a reason to take the trade and it wouldn't be a reason to dismiss the trade. But one of the concepts that you can expect is that if buyers have completely taken control here, they're happy to go and hit anyone that's on the offer. It's a fair assumption then that buyers will be happy if they get the chance to buy at these prices once more. And what happens? Market drops down, you get a bid and an absorption, or it may well just be a bid itself filled. 123 contracts. Market trades down, hits them exactly where people were willing to take the initiative and drive through to sellers. This time, they're willing to sit there and say, yep, you can come and hit me, and then we're going to take this one back higher. That's exactly what you get. Very quick reverse, very light in color down here. This shows a move that has been quick, is not going to spend any time down here, and very, very quickly gets itself back trading much higher prices. So that's how you can be using imbalances, is to pinpoint those areas where you might want to take a quick trade. If you get a fast move to them, the reaction away from them. Equally, once you start to see these imbalances stacking up, that also provides you with an area of support that you can then use in order to enable the next leg of a move or a sort of consolidation area, and pinpoint that for you as well. Next profile concept then is crowding. So this is the idea of creating volume within an area. Similar to a market profile type concept, what we've looked at so far has been where direction has changed. You've either looked at individual price absorption or absorption stepping up and becoming more aggressive buying, or we've looked at those areas where you get imbalances and rejection away from them. Now what we want to have a look at is the idea of markets building up acceptance in areas. So willingness to trade, sort of rotate within certain areas. And what that does for you is it builds positioning. This is similar to a profile type concept. So what you want to see then is that positioning building up. I mentioned color on the oil drop, and it's a similar kind of concept. You're looking at where do we start to actually build the volume up on this type of profile. What you started to see then is after building the volume up here, we get a sell-off and the market moves straight the way back. We then don't see the buyers deter. This pretty standard concept of drop out of range back into range. So whilst we were looking previously at the precision behind the reversal, you don't always get that opportunity. Indeed, in this situation, what we have is the concept of moving back into a range whereby the market then, or buyers then, are happy to come and buy at the bottom of the range. This then is what enables the market to hold up. Buyers have decided that, yep, we're back in the range. Where's the best place to buy in a range? Where's the best place to buy in a range? The bottom of the range. If not, you're going to buy the break of the range. So buyers logically start to move their bids higher and start to crowd this area. This then brings in a lot of trade in this zone as well. So there's much more volume starting to go through. This is then recrowding the area where participation happened previously, building energy up. Now, this doesn't guarantee that we move up. This could well build position to then roll towards the downside. So this is more a judgment of whether the scope of the move is there. And as you spend this time building up and building up, one of the things that is worth noting is the delta consistently rising. Now this is a delta grid. What this shows you is the delta on each rotation or each candle, however you have that set. It will also give you things like the volume as well. It will give you the specifics of number of buyers versus number of sellers. But really what you're mostly looking for is the delta on each candle and the cumulative delta, which is this one here. Now, what you've got in this situation is delta steadily going up and up and up. So whilst, yes, you're crowding the market out here, you've got lots and lots of positioning, a lot of this is all buying. People coming in, and well, let's say all buying, it is weighted towards buying. There are more buyers than sellers at this point. So that's giving you a little bit of a clue. It's not a guarantee, but the fact that you've now seen a rejection lower, you're now seeing crowding out of an older area with delta rising from a buyer's perspective, this is now saying to you, yeah, buyers are now more confident here. The final little bit of information, this doesn't have to follow. You could have a crowding move that breaks out and then turns into a very strong move towards the upside. However, as a sign that buyers are still willing to continue this move higher, the question then comes, are they willing to then participate when you break the range? Because if they're not, what you'd expect to see is some light volume, something like you've got over here or even here. Not a great deal going on, but instead what they've done now is they've changed the perspective. We've built acceptance down here, and then having got out of the range, we're now starting to see more and more action here. That action at the top of the range is what's allowing then the market to drive towards the upside. So it's about then using the sort of positioning, the way people are moving to allow for that move, rather than, again, trying to be very, very specific. It's sort of seeing the structure of what's happening more generally. Again, this then overlays a profile. You'd see this building up on a profile, but what you wouldn't get is the granularity of how delta is changing individually within each different type of movement. That's the bit that's different. And in particular as well, this one where you actually start to get that move higher, delta is much, much higher. Now, the difficulty that we'll have with that, I'm going to come on to in a moment with a delta punch move. But very importantly here, delta does go up significantly. These are all in the sort of, bar the rejections down here. Once back into range, sub 500s, and then we get 750 and another 700 here. Those are the two that show you that there's now a willingness to buy even more aggressively, despite the fact that price has moved higher. It's nuances, but they're the little details that are going to help you say, yep, this is now a move up, and I'm happy to now buy, even as we drop back down onto the top of that range for your more passive entry. Notably, yes, you do have passive buying, but the numbers hitting into the offers are just as big, and in many cases bigger, showing acceptance, showing willingness to trade at these higher prices. So on to that delta punch then. Now, you can see a delta punch from cumulative delta if you have it on a chart. And this is then looking at the opportunity to get into a trade once the move is going, rather than the opportunity to try and find the low, find the reversal point. So you're always trying to give yourself options. You don't want to just say, right, this is my trade and this is where I'm getting in. Because if you don't get that opportunity, if you don't get, let's say you're somebody who looks for a false break and you don't get that down there, there's no trade, you've missed it. So you're asking yourself, right, well, if I can't get that reversal from the low, how else can I get into this trade? A more directional, or you could call it a breakout reversal type move, however you want to term it. But you're looking at then the shift in the way the market trades and what you can then look for after this and how you would play it. Now, with a delta punch, the difficulty that you have with these is that they're very visible after they've happened, not so as they happen. That's the difficult part. However, you can have an expectation of where they're going to happen. Now, your two areas where you're looking for a delta punch are going to be here, as you break out of the range, and also up here, as you break the volume ledge. They're going to be the two areas where you can look for this punch of delta, and that being the sign to jump into the trade, the sign that, yes, the move is on, you can get in, you can stay in this. So that's the bit that we're going to be looking at here. So that's what we've now got. So you've got two options here. We're either going in at around 25 or in at around 48. It's not super obvious as well from the steady cumulative delta here, but where it is much, much more obvious is once you start to move higher. This then is on a rotation-based chart, not on a candlestick, and this is where rotation helps you. So with this, yes, you do have an element of the possibility of a reversal, that you get an absorption lower. You've got these couple of blocked areas where you're not seeing that participation. These are the zones that the market can rotate across. So if you're trying to find a reference within a range, these are the areas to go looking for it. But look now, once you get the breakout of that block, the initial move comes here, that takes you above 25. You do actually start to get a little bit of crowding at these higher prices as well. Volume's now starting to accept at these higher zones. But then what you get, and this is the bit that says, yeah, the move is definitely on. And this can add conviction, even if you're already in the trade. When you see this and you look at this rotation, 2,300 of delta, compared to anything else, it is way bigger, more than double any of the other candles. That comes on that break point, that point where you're looking for the market to accelerate, and it does it. Now, it's very easy to say, well, once you've seen that, go and buy it. The problem that you have, of course, is that to get the break, to get that pace, you need buyers to be more aggressive. So the delta punch is almost explaining to you what you just saw. Great example of being able to spot the aggressive action, to spot the breakout. And if you sort of were looking at the way it traded and thought, yep, breakout, and you go and hit it, and it does that, and you get that delta punch, let's say if you're buying it as you go through what were the highs of that little range, buy it there, and then you get that delta punch. This is where you think, yes, I've got this, I've nailed this trade, and you can then confidently add on as well. If you're not in though, this is where you have to back what you're seeing and be a little bit more willing to pay higher prices. It may well mean that you have to buy it up here, 35, 36 area, with your stop down here. It may seem slightly uncomfortable, but you've just been told everything you need to know. There is a very, very strong willingness of buyers at exactly the point where you would want to see them. You want buyers up here, and you're getting them. This is just what you want to see. So yes, it may give you a bigger stop. Yes, you may have to pay a 10 tick stop, but you've just been told that this is probably going to work for you. So that's where I kind of look at a delta punch trade. It's not so much about the just simple, oh, you see the delta jump, go and get into the trade. It's got to happen at an area where you're expecting something like this to happen, where you want to see that type of action, that type of aggression. When you get that, then you go for it. Without that, then you may well be a little bit more cautious. It could well be as well, if you don't get that delta punch on the way out, be more confident to wait and let the market come back so I can buy more passively. As it comes back, you'll find out whether passive buyers are there and able to hold this up. Otherwise, you don't want it. But with that delta punch, it says to you, yes, the time is now. You don't need to wait for a passive entry. You don't need to wait for this to come back if you're already in. This time it's going. That's the big advantage of a delta punch. That's what you're looking for to get these types of moves. Different to a delta punch, it may well in some cases look like it, but realistically, this is a different scenario. And this is what I would call an absorption wall, and in this instance, an absorption wall break. Now, an absorption wall is a relatively obvious concept. Icebergs, so if you're looking for an iceberg, this is a good, easy way to spot it. Icebergs, i.e. they don't let the market go higher, they sit on the offer or on the bid, and anyone who comes to buy, they just reload that price. So you have that here, at the top price, and again, 300, 600s in oil at one price. You need the ladder to know the difference between whether this is an iceberg or whether this is just a large order, because the way you trade it is going to vary. If it's a large order, you can see that large order ticking down. So you know how much is left, you know when your likely chance to hit it is coming. If it is an iceberg, you don't. You don't know how many times they're going to reload that, how many more contracts they've got to keep on adding on. And this is where Footprint's helpful. Excuse me. So what you're looking for then is the ability to say, yeah, this time I'm going to go for this. You don't want to be buying it here. You don't really want to be buying it here. So what is it about this that makes this different? The main thing that makes this different is the way things change once you get up towards it. In both of the two previous instances, as soon as you get up there, any buying into the offer is more than matched. So what you've got here is more buying or more passive selling compared to passive buying, more passive selling, and again, and again, and again, and again. Same here. So what that's showing you is that people are actually sitting in front of that large order as well. There's more people getting in the way than there is willingness to go and hit through them. So people hit through them, hit that large order or iceberg, goes nowhere, and they get out of the way. So what that's showing basically is that when you get there, as you move up to the order, people are willing to buy. But as soon as it hits it and everyone realizes it is a large order, they lose that willingness to buy. They get out of the way, and that's what allows the market to drop. What you want is a situation where we trade up to it, and as it comes back, people don't get out of the way. i.e., when people come and sell because they've seen that order again and they now sell at market to try and get the move to go lower, it doesn't. It sticks. So what you're getting then, and what you can be looking for in these situations, is hit now, you've got more buying than selling. So more passive buying than passive selling. i.e. when sellers come in, buyers are there. That's now creating that pressure, and that then is what can allow the next leg of the move up. Allow that break, give you that confidence, because yeah, this time I can hit it. Think about the way we looked at that on a price ladder when we looked at breaking an iceberg, where the market gets sort of jammed towards it. It doesn't roll away. That's then the time we can say, yes, this one is going to go. I can get in this just below the iceberg, also with a stop just above it. You have a stop just above it, or a willingness to then buy as soon as it breaks. You can then add on to this trade with a very likely imbalance, which is what you get there. Zeros here, 10 trades, 11, 24. There's virtually nothing trades. It takes all of those offers that are just above that large order or iceberg out, and the market then accelerates higher. Excuse me. So what that's then giving you is the ability to differentiate between the ones that aren't working, be able to say, yeah, I think this one could work. Then hit it with the expectation of this faster jump, and once you get that, again, like that delta punch idea, which is likely what you will see in this instance, like that delta punch, you're then able to say, yep, this is highly unlikely to come back now. I can be confident, even if I'm paying up here, yes, it might be a 10 ticks higher, but this isn't coming back. Of course, you need this to be at a point where you have expectations of a further move. You don't want to just go, oh yeah, broken an iceberg, buy it. You could be buying it into a very significant level. But if you have an expectation of movement, this is exactly the time to be able to spot that. Again, I talked about the idea that this gives some history. You might have come in here, not seen what had gone on there from a ladder. You'll see some volume at the top, but you don't know how that's created. This gives you a sense, this now gives you the ability to say, yeah, I now get this. And when I see a change, not just in that number, but in the way it's trading around it, I'm willing to go for it. That's how you want to be trying to think about these types of concepts. One of my favorite trades, mostly learned from it being one of my most hated situations. The situation where you feel trapped, and then at one point you know you're trapped and you cannot get out and the market runs from you. It's a horrible sensation because you think, oh, it'll come back, it'll come back, it'll come back. And it doesn't. It doesn't tick back. It doesn't let you out. And then you chase and chase and chase and hit, and then finally that's around about the top of the move. It's a horrible thing to happen. By understanding what's going on, you then can understand how this type of situation arises. This is, again, similar kind of concept to a poor high or a poor low positioning reverse that we looked at with profile, just on a much shorter timescale. So the idea behind the trade, this situation in oil. If you want the date, you want to go and replay this, go and have a go. You're going to be replaying it from around about 2:15. So what happens here then is market's dropped. Okay, that makes sense. Market drops from this upper range down through this previous range. Bearing in mind, this is a short time frame, 1 minute chart. So you're looking at sort of mini ranges within the day. So market drops down. And then we get this relatively bad low down at 73. Market is pinned down there. What does this mean? Well, people are going to be happy to try and sell for the continuation. They've just missed this 60, 70, 80 tick move. This is their chance to get in on the next leg to then go and have a shot at the low of the day. Essentially, this move is what they're after. And they do get eventually. But what happens before that is a classic example of what I would call a scramble. Everyone fancies this trade. Everyone can see the concept of the trade. Therefore, people are quite happy to sell right down at the lows. You'll see this in a moment. This means everyone's vulnerable and everyone's probably trapped in roughly the same position. If you're one of those sellers, you know it, but only when the market starts to bounce. Until it starts to bounce, you don't know that the scramble is on. So it's more about the concept that this allows for the scramble without necessarily saying to you that it's going to happen. The scramble is then trying to pinpoint the area where that panic's going to set in. Because if you can pinpoint that, you can be short. And if it doesn't work, you know to get out. Don't mess around, don't hesitate, don't think, oh, well, it might come back to me. It won't, it will run. So you don't want to be doing that. As such, you look at it and think, so, right, I can see that pinch point. Equally, if you're not somebody who wants to be short of the low playing for the aggressive break, you know that there's then going to be a very quick break and fast move to the upside coming. 1 point on a scramble move. Once the scramble is done, don't expect continuation. This is just merely catching out these people down here. It's a trap, basically. People get short, they don't get the move they're after, they get trapped, whip, back up you go, and everyone gets caught out on the move. So that's exactly what's going on there. So let's go and have a look at what this looks like on a footprint. What you get down here, as you fall into that little zone, so let me just show that little zone runs from around about 73 to 73.10. You fall into that zone and you start to see absorption down at the lows. Now, not something you haven't seen already. You've seen some reasonable chunks of absorption already on the way down. And again, a few hundreds sitting down at lows, nothing to be overly fussed by. That's just the way it's trading. You get lots of people just keep on buying down at lows. That's fine. But this then continues onwards. And that initial 170 that you see trading down here becomes over the next candle. So this is basically this candle seconds later. So it's a screenshot of this as it happened, then becomes 1,500 contracts. So now you have a situation where somebody really is trying to hold this up. Two directional trade now, you've got an absorption wall. Market's been held down, or pushed down, held. This then opens up the possibility of reversal back up. And that's exactly what you get from here. Now, from this point of view, there's not an obvious scramble. You can't necessarily just say, oh yeah, I'm going to buy it here and look for the scramble, because if it doesn't materialize, market then goes straight back in the other direction. And will then break, you get caught out on a break through the low. Fine. So you could play it like that, but that's really more just a front running a large order type trade or front running an iceberg type trade. So instead of that, we're looking at, right, where did the action change? One area of importance is just here at 10. You've got zeros over here so far. So very, very little trade apart from that one large order that held or absorbed initially on the way down. That's an area that you can be interested in. And then you've got the obvious 15s, which is where the peak of any bounce has come from. So you've got 2 points now, or you've basically got a 5-tick range where you can look to see a change from what's been happening here, and then use that as your cue to enter for that scramble type move. So what we get then, back up to where there was a lack of participation previously. Back up to where that large order got broken through. So what you need now is, and just to explain this in a little bit more detail, we've gone down, we've got that absorption, which then runs all the way up to 1,800 contracts. Market bounces. So people then come in and try and buy on the way back. Can't get through 10. So, can't get through 10, back down again. We don't get the large order, we don't get the same level of absorption here, but you don't get continuation. That's a little cue. But as I said, it was about looking at where there was a lack of action. Not just saying, oh, the top of the range is 15, that's where the break comes from. By that point, people could already be panicking about this. So, back up towards 10. And what you now have is some volume done. This is the last chance. If this is to keep going, sellers need to hold it here. They've managed it previously, or they've managed it by virtue of a lack of buyers, more so. The 4 at the top with nothing, 7 below it, 6 with 12 below it. There's no buyers up there. So when you get back there, if somebody does come to buy, sellers have to defend this. And if they don't, if they can get overrun, that's where the scramble begins. That's where everyone who's short in here, or everyone who's been selling it, more importantly, down here, now starts to think, oh, I'm in trouble. They then run for the exit. This means you've got around about 5 ticks to get out. If you don't, the market will then rush towards the upside. And you look at what happens here. Each of these, this is on a rotation basis, each of these is taking minutes. Here, that's a minute to do. Oops. That's a minute, that's a minute. This one, that takes 5 minutes to create that little bit of action there. So you're getting much, much more time spent down here. Whereas this is 1 minute to go from here all the way to here. Very fast, very quick move. Look at what trades. If you don't look at this from the point of view of understanding this area, and you don't get out by 15, which, let's face it, most people are going to sit there and go, I'll see what it does at 15. Well, it goes straight through it. It doesn't tick back. 3, 8, 2, 1, 11, 14, 2, 3, 2. There's nothing trading back into the bids. So if you're waiting for somebody to trade back to you, the market runs. And that's the situation of a scramble type trade. People get trapped in selling at lows. Everyone knows, and I'm sure you would have felt this yourself. You sell and you think, this is a bad position. I'm not comfortable. I don't like this position, but you're hoping that this large order gets broken and the market accelerates to the downside because you can see the potential. Don't get me wrong, there's nothing wrong with that idea. But you have to be aware of the other side of that, of the market mentality that you're seeing getting built up here, that everybody's in the same boat as you. And if it starts to turn, everyone's going to run for the exits together. So looking at then the distinct nature of how this is formed, and it won't always form exactly the same, but looking at where those change points can come from a footprint, allows you then to say, yes, I need to get out of this. And it lets you out, or it can give you the chance to get out before you end up joining everybody else running 30 ticks before it then finally slows down. You get some action, market starts to accept up here and then falls away again. This then instigates the next leg down. But you've got caught out here. You've got squeezed. That's the squeeze. That's the trap. That's the idea of a scramble type trade. Final major use I find for footprint is defining stops, and particularly for those looking to be a little bit more accurate on a stop. You know, it's easy to look at a chart and say, yeah, well, you see this happen, you get in and you put your stop above the high. Now, technically that's fine, and you might be able to justify that from a risk reward perspective. Let's take, for example, breaks the high, fails to stay above it, you sell when you come back below the level at 67 and a quarter, and you say, right, that's fine, I'll sell 65, put my stop above the high, I'll take a 10 handle stop on the S&Ps, 10 big tick stop, and I'm going to play for this move down here. That move is 25 handles, so risk reward wise, it's acceptable. But from a monetary point of view, is that acceptable? Are you happy to take a 10 handle stop? Bear in mind that's $500 per contract. Yes, you get a decent payout on that, absolutely. You're going to make 25, so that's going to give you $1,250 if this works out. So it's not a bad risk reward, but the reality is you may not be willing to accept that size of loss if indeed it goes wrong. So how do you play a trade like this and refine that stop down? Note also that when you get the first false break, it goes again. You know, we trade above 67 and 3/4 on that first green candle, then we trade higher. Then even on the next candle, once you would think, oh yeah, we're back below 67 and a quarter, it still trades above the level again. This is where people get caught out. They try and sell, then they stop out, and they sell and they stop out, and they sell and they stop out. What we want to look at then is using the footprint to enable you to understand what's going on a bit better. Now, first time we get up there, up towards 67. That's the blue line here. The first time we go there, we go just above the level, just back below it. But note here, there's a lack of rejection at these points. That's not a very clear indication that this move is over. And following that, then trades below, above, below, above, below, above. So market is basically crowding this area. This then gives opportunity for the next leg up. Next leg comes then. This is where you can now start to genuinely think about the reversal. If you just go straight for it and you go, okay, it's gone up, it's come back, and sell it on the way back down here, you run into trouble almost immediately. That's because you've not got enough of a rejection move here. You're not seeing this exhaustion type move or any kind of clear absorption and then roll away from it. You get that up here. Market breaks out. Nice quick move on a break, nice light color, lots of imbalance up here. Good. That's now where you expect continuation. You don't get it. You get some absorption up here and then a very quick rotation back. Think of a kind of switch trade concept. That's where the market then turns back. And then we get this kind of small crowding area up here. That runs from 69.5 to 70 and a quarter. So this is the area where the turn comes from. Either at this point when this is forming, and we know what happens afterwards, but initially when this forms, this could be the beginning of this leg or this leg. So that acceptance, that crowding of action here, is what then tells you about the importance of that area. So market then falls from there, does break back below 67 and 3/4. That could be one option to trade. You could take that break, play the move down. In terms of placing a stop, because you've seen this, you've now got the opportunity to place your stop above that. Not above 67 and a quarter, because if you do that, you get caught out over here. Also, not above the high, because if you do that, it can be a rather costly trade. In this instance now, you're only taking maybe a 3.5 handle stop, not looking at the much larger 6, 7, 8 handle stop to get yourself comfortably above that recent high. Likewise, because you've now seen what happens on this candle, so if you're not very aggressive here and you've seen what's happened, you can now use this on a retest. Market comes back. This is where the rejection really comes in. That's where we saw that sellers had control every time apart from once. They regained control, market goes back there, and now you've got a very clear stop, in this instance giving you maybe a 2-handle stop. That's what a footprint gives you. It gives you that accuracy that you're not playing from the level now, you're playing from what happened in creating that, what I call fudging of the level. So when it sort of goes through and then it struggles and rolls back, when that happens, you can now be clear on what exactly you're trying to do and where exactly you can define a stop. This can be really helpful because it then allows you to take on so many more trades. Yes, of course, technically you should place your stop up here, but you're using the information of not where technically the candle stopped, but the information of how it got formed, what happened, because that really is what matters. That's what generates the move. That's what tells you what's going to happen from here, not precisely where the top of that candle comes in. So you can be confident then to put your stop much smaller, just above that area, to then allow to play for that next leg towards the downside. So there we have it, footprint. Hopefully I've given you or formalised some concepts. The idea is not to try and do a huge lesson on how to use footprint, but more about formalising a concept, something that you may well have already seen, and to try and give this some kind of form, some kind of way of using it. Bring it into some of your trading. We'll have a look at it in the afternoon session along with exercise as well. But start to bring that in, but use it for specific things. Like any indicator, when it is not a price adder that is showing you exactly what is happening right now, use it as a way to enhance your understanding of what you're already seeing. Use it as a way to refine entries, to better place stops. These are the marginal gains that you can get with that level of detail. That's how you want to use it. I would not use Footprint as a replacement for a price adder. It simply doesn't give enough information. There you go, Footprint.